Investors are in a holding pattern, waiting from now until mid-September when the Federal Reserve's policymaking arm releases its latest statement and Chairman Ben Bernanke emerges for what could be a critical press conference outlining how or when the central bank will taper its monetary stimulus programs. Srinivas, Thiruvadanthai, Research Director at the Jerome Levy Forecasting Center, joins me today to discuss. Srinivas, so glad to have you here.
Thank you very much.
So Srinivas, I'm wondering, is the Fed's next statement so highly anticipated that markets are just going to trade sideways and ignore all the other important economic data that comes out between now and then?
That's actually not quite true. I mean, yesterday the statement came out and the markets gyrated. But today we got some good news out of Europe and out of China, and the markets have reacted positively. So it's not exactly clear that the Fed will dominate the direction from here. But it is a huge influence. You know, QE as a policy doesn't really does much to the economy or to interest rates or to the markets over the long run. But the short-term gyrations and market psychology, especially for traders, it's so huge that it is going to play a huge part.
Yeah, and so one thing I think a lot of people are wondering is how much does quantitative easing actually affect things in the markets, like bond yields or even the equity markets?
Of course, you know, the short-term gyration, you can see, I mean, the day Bernanke comes and speaks and the day they make the announcements, obviously there is a huge amount of influence on these kind of, and I don't want to discount the influence of QE in those kind of things. But if you look over any duration past those very short-term ones, there is not much evidence that QE has much influence on yields, let alone on the broader economy or on inflation, expected inflation or any of those things. Because San Francisco Fed, in fact, had a recent study saying that QE's influence on yields is marginal.
Yeah.
And you can see, peruse from the actual history and see that it's not much of an influence.
So why are so many economists convinced that the language suggests a September taper?
Well, you know, it's hard to say because you know, the language between yesterday and the previous meeting, there was not much change, and they didn't show their hands, tip their hands into whether it's going to be September. They kept the language pretty much the same. I guess they're convinced that it could be September because the economy has more or less followed the path that the Fed thought would cause tapering, and that's why probably they're convinced. It's hard for me to get into the rights, but that's what I think is playing.
Sure. Yeah. Well, let's jump ahead. Tapering is happening. Let's assume tapering eventually will happen.
Right.
At some point, they're going to want to end the program. So I'm wondering, when do you think that they'll end quantitative easing? And then also, will that whole discussion of when they end it become the discussion we're having now of tapering?
Well, you know, again, here is they have put up a schedule for ending of tapering sometime next year, which is predicated on, and they were very careful that it is predicated on particular set of things happening, you know, to the unemployment and to inflation, and so therefore it is data dependent. It's not set in stone, and it will depend on a whole lot of things like what's happening to fiscal policy here. We still have the full impact of sequester is not clear. We don't have the budget for next year. There could be more tightening than fiscal policy in Europe. What is the direction of the emerging market economies? So there is a whole lot of things that impinges on the outlook that will determine what the Fed does.
Srinivas, thanks so much.
Thank you very much for having me, Joe.
For The Street, I'm Joe Doe.